Hey guys, very warm welcome everyone to today's session. So we are starting our domain analytics from today, and I will be talking about capital market analytics during these days. So we will be trying to understand what are the capital market, what are its applications, how can we use data science for our capital market analysis, and so we will also be trying to do your clustering, multi-layer perceptron, and various other techniques during these days. So gradually we'll be covering all these things. Okay. So guys, let us start this session. So we are going to discuss about the capital market analytics. When we talk about your capital market analytics or capital markets, if I were to say, capital markets are where savings and investments are channeled between suppliers and those in the need. Suppliers and those in need. Suppliers, when we talk about, are the people or the institutions with capital, which are having capital, and they want to lend or invest. And these basically include what? When we talk about suppliers, then we can say we are talking about your banks and investors, right? So these are your suppliers. Now, those who seek the capital in this business market are, in this market, you can say are people or, entities, those who want the capital. They may be businesses, governments, or individuals. Capital market is all about this. It is nothing but capital markets are where your savings and investment are channeled between your supplier and those in need. Suppliers and those in need. That is your capital market. The same is what we have over here. Capital market is a place where buyers indulge in a trade, that is buying and selling of financial securities like bonds, stocks, so on and so forth. The trading is undertaken by participants such as individuals. These are your nothing but your investors and institutions like your banks. When we talk about capital market trades mostly in the long-term securities. The magnitude of a nation's capital market is directly interconnected to the size of its economy, which means that ripples in one corner can cause major waves somewhere else. And when we talk about your capital market, it is further categorized into two parts. One is your primary and one is your secondary. So primary market is the market for new shares or securities. A primary market is one in which company issues new securities in exchange for cash from an investor or a buyer. And this deals with the trade of new business of stocks and other securities that are being sold to the investor. Another one is your secondary market. When we talk about secondary market, it deals with the exchange of prevailing or previously issued securities among investors. Once a new security has been sold in the primary market, an efficient manner must exist for the issue. What happens over here is your secondary market, it gives the investors the means to trade existing securities. Another important division in the capital market is on the basis of nature of security that is being sold about. That is nothing but a stock market or the bond market. They seek to improve the financial efficiencies by bringing the suppliers together with those who are seeking the capital and providing a place where they can exchange the securities. So, capital market refer to the venues where funds are exchanged between suppliers and those who seek capital for their own use. Right. And suppliers in capital market are typically nothing but your banks or the investors that we have seen earlier. While those who seek capital are your like business, governments, or individuals. Capital markets, another thing, capital market are used to sell different financial instruments, including your equities, and debt securities. And when we talk about the best known capital markets, we all have heard about the stock market and the bond markets. Now, another thing, how is your capital market working? A capital market assists an economy by providing a platform to gain funds for business operations, development activities, or wealth enhancement. So what happens? The functioning of your capital market follows the theory of circular flow of the money. Circular flow. Right? For example, if a firm needs money for the business operations and usually borrows it from the households or your individuals. In capital market, the money from the individual investor or household is invested in firm's share or bond. And in return, what happens? Investors gain profit as well as goods and services. The market comprises suppliers and buyers of the finance, along with trading of the instruments and mechanisms. There are also regulatory bodies such as your stock exchange, equity markets, debt markets, options markets, so on and so forth. These are the various examples of the capital market that we are having. When you talk about your capital market, the term capital market is a broad one that is used to describe the in-person and digital spaces in various entities trade different types of financial instruments. Now, these venues may include the stock market, They may include your equity markets. They may include your bond market, debt market, so on and so forth. Another thing, capital markets are composed of the suppliers and the users of the fund. Suppliers include your household, as I told you, as well as your institutions like your pensions and retirement fund, your life insurance companies, charitable foundation, or your non-financial companies that generate extra cash. The users of the funds distributed on the capital market include your home and the motor vehicle purchases, non-financial companies, and government financing your infrastructure investment that we saw, development activities, and your operating expenses, you can say, wealth management, so on. Capital markets are usually, or you can say, are used primarily to sell financial products such as equities and debt securities. Equities are nothing but your stocks, which are ownerships in the company. And debt securities such as bonds are nothing but your interest bearing IOUs. Capital market, guys, are crucial part of your functioning modern economy because they move money from the people who have it to those who need it for its productive use. So, capital market follows the theory of circular flow of money. So what happens is, if I were to tell you one thing, small investors are often unable to buy the securities of the primary market because I'm talking here about the primary market. So what happens is, these small investors are, oftenly they are not able to buy the securities on the primary market because the company and its investment bankers want to sell all the available securities in a short period of time to meet the required volume. And they must focus on the marketing to sell to the large investors who can buy more securities. Marketing the sale of investor can often include a road show of your dog and pony kind of show, in which investment bankers and companies leadership travel to meet the potential investors and convince them of the value of your security being issued. Whereas when we talk about your secondary market, the secondary market has two different categories. Further, one is your auction. Again, one is your auction and one is your dealer. The auction market is a home to the open outcry system where buyers and sellers congregate in one location and announce the prices at which they are willing to buy and sell their securities. For example, if I were to give you like New York Stock Exchange, whereas in your dealer market, though people trade through different electronic networks, most investors deal with your dealer or dealer market, right? Another thing that comes to our mind is that what about your financial markets? Are your capital market and your financial market the same? So if we were to talk about the similarity of your financial markets and capital markets, that are they both same or not? There's a great deal of overlap at the times. We all are aware of it. There are some fundamental distinctions when we talk about capital market and your financial market. Financial market encompasses a broad range of venues where people and organizations exchange assets, securities, and contracts with one another and are often secondary markets. Whereas when you talk about your capital market, these are used primarily to raise funding, usually for a firm to be used in operations or for your group. Talking about the elements of the capital market. Individual investors, commercial bankers, financial institutions, insurance companies, business corporations, and retirement funds are some of the significant suppliers of the funds in the market. Investors offer money intending to make capital gains when their investment grows with time. In addition, they enjoy perks like dividends and interest and ownership rights. Companies, entrepreneurs, governments, so on and so forth, are nothing but your fund recipients. For instance, if the government wants issues your debt instruments and deposits to fund the economy under development projects. So usually what happens is long-term investments such as shares, debt, government securities, debentures, bonds are traded away. In addition, there are also hybrid securities such as your convertible debentures, preference shares, so on and so forth. A stock exchange operates the market predominantly. Other intermediaries include your investment banks, venture capitalists, and brokers. These are all your elements of the capital market we're talking about. Regulatory bodies have the authority to monitor and eliminate all illegal activities in the capital market. For instance, the Securities and the Exchange Commission overlooks the stock exchange operations. The capital market and the money market are not the same, that we were discussing. Securities exchange in the former would typically be a long-term investment with over a year logged-in period. Short investment trade in the money markets and include a certificate of deposits, bills of exchange, promissory notes, so on and so forth. So these are the various elements that we are having for our capital market. Now, talking about the functions of the capital market. Capital market mobilizes parties' savings from cash and other forms to the financial market. It bridges the gap between people who supply capital and people in need of the money. Banks, venture capitalists, governments, individuals, right? Business owners, so on. Any initiative requires cash to materialize. Financial markets are central to national and economic development as they provide rich source of the funds. For example, the World Bank collaborates with global markets to mobilize funds to achieve its goals, such as poverty elimination. The International Bank for Reconstruction and Development, IBRD, has assisted over 70 countries by raising nearly $1 trillion since the first bond in 1947. Likewise, a report suggested that the European Union companies need to turn to this market to manage their pandemic balance sheet, as banks alone will not suffice. Right. For the participants, the exchange instrument possesses liquidity, that is, they can be converted into cash and cash equivalents. Also, the trading of these securities becomes easier for investors and companies. It helps minimize transaction and the information cost. Another thing, with higher risk, the investors gain more profits. However, there are many products for those with a low risk appetite. In addition, there are some tax benefits obtained from investing in your stock. Usually, the market securities can work as a collateral for getting loans from the banks and your financial institutions. But we have seen, in the recent times, how these can be outplayed. We have seen a lot of cases in India itself. Talking about the downsides of our capital market. Investments in shares and mutual funds are deemed risky as the investment is highly volatile due to your market fluctuation. Therefore, there is a massive chance of losing money to market risk. Market fluctuation risk one's investment and hinder a fixed income, you can say. Those who are investing their hard-earned savings, such as retired employees and senior citizens, will prefer the safety of their funds to the higher earnings when it is compared to your higher. With the range of the investment alternatives present in the market, an investor may not make a fruitful choice without professional advice. So we have your nowadays, you must have seen that in the bank, we are having your wealth consultant. Right. Professional advice. They are providing you professional advice on your wealth, on your savings. Trading of the securities may involve brokerage fee, commission, so on and so forth. So what happens when all these factors are included? The cost of the transaction will increase, obviously. Talking about the firms, when we talk about various firms that we have, what markets do the firms use to raise the capital? The companies or the firms that raise equity capital can seek private placements via angel or venture capital investor. Angel investor or venture capital investor. But are able to raise the largest amount through an initial public offering. When shares list publicly on the stock market for the first time. Debt capital can be raised through bank loans or via securities issued in your bond market. So these are how your firms are raising the money, either via angel investor, your venture capitalist, or through your IPOs. Right? Another thing, are your capital market efficient? What is the efficacy of your capital market? What happens is most markets are not perfectly efficient. Same comes for your capital market. The capital market is no exception in this case. But compared to other markets, the prices of the securities reflect that they have incorporated the current information in the market. Another thing, when we talk about your capital markets are very important part of your financial industry, as we talked about. So what they do is they bring together the supplies of the capital and those seek it for their own purpose. So what happens is there's a circular movement. There's a circular movement of the money. Right? So it churns the economy. It ensures the economy is moving, the money is moving in the economy. When we talk about the regulatory framework for the capital markets, these are the few institutions of governing ordinance for the capital market establishment. Securities and Exchange Ordinance, which was formed in 1969. Companies Ordinance, formed in 1984. Securities and Exchange Rules in 1971. Broker and Agents Rule, that was formed in 2001. Non-banking financial companies, NBFC, in 2003. Non-banking finance companies regulation 2008, and REIT regulations, that was formed in 2000. Then comes the intermediaries, brokerage industry. We all are aware of brokerage or broker. So suppose you are buying a land through a broker, they will charge you some money. Or a deal, if it is cracked by a broker, they charge you commission. Right? The members of the stock exchange are known as your brokers. Under the law, brokers are entitled to provide brokerage services, deal, to the public at large for buying and selling the shares. Investors do not deal with the stock exchange directly to buy or sell your shares. Instead, what they do is they do it through a broker registered under your SESP, the Stock Exchange Commission, right? No. Another thing. Suppose, or let us understand a scenario where, there are no markets. So what will happen? Without market for your stocks or your bonds, business owners, what they will do? They will be having fewer options to bring their ideas to life or to expand their businesses. They would have to save up enough cash to reinvest. With healthy capital markets, business owners can obtain the needed financial capital to build a successful company. They can also expand existing business to create new jobs, as well as what is strengthen the economy. Another thing when it comes to a capital market is it also reduces the cost of doing business by providing the global economy with a reliable source of cash or the liquidity. And how is that happening? Because your capital markets bring the borrowers and the lenders together in efficient ways and help channel resources to create a healthy national or global economy. They provide essential funding that is affecting people's life in many ways, from starting a business to you can say expanding a current business, or providing investment opportunities for people planning for their future, so on and so forth. So capital market, it allows the traders to buy and sell the stocks, bonds, and enable the business to raise financial capital to grow. Businesses also have reduced risk and expenses in acquiring financial capital because they have reliable markets where they can obtain your funding. Capital markets are there to match them with the best funding source, right? Suppose that one day you are having an idea of like healthy ice cream that you want to turn into a business. Now the capital market is there to help you make it happen. And that's the nothing but your screw on a lighter note, right? That is nothing but your screw. Okay. So what all things we understood till now? Capital markets, these refer to the venues where funds are exchanged between suppliers and those who seek capital for their own use. Suppliers in the capital markets are typically nothing but your banks and the investors, while those who seek the capital are your businesses, governments, and your individuals, people like us, right? Capital markets are used to sell different financial instruments, including your, equities or your debts, securities. These markets are divided into two parts. One is your primary and your secondary. The best known capital markets include your stock market and your bond markets. When we talk about the transaction on the capital market, these are generally managed by the entities within the financial sector or the treasury departments of government and the corporations. But some can be accessed directly by the public. If I were to give you an example of, say, United States, so any American citizen with an internet connection can create an account with your Treasury Direct and use it to buy bonds in the primary market. Though sales to individuals form only a tiny fraction of the total volume of the bonds sold, various private companies provide browser-based platforms that allow the individuals to buy shares and sometimes even bonds in the secondary market. Right. And when we are talking about again the controls of your, this capital market, so capital controls are measured imposed by the state governments aimed at managing capital account transactions. In other words, if I were to say capital market transactions were one of the counterparties involved is in a foreign country, whereas domestic regulatory authorities try to ensure the capital market participants trade fairly with each other. And sometimes to ensure institutions like banks do not take excessive risks, capital controls aim to ensure the macroeconomic efforts of the capital market do not have a negative effect or impact. Most advanced nations like to use capital controls sparingly, if at all. As in theory, allowing markets freedom is a win-win situation for all involved. Investments, investors are free to seek the maximum returns, and countries can benefit from the investment that will develop the industry and infrastructure. However, sometimes your capital market transactions can have a net negative effect. For example, suppose in a financial crisis, there can be a mass withdrawal of the capital, leaving a nation without sufficient foreign exchange reserves to pay for the needed imports. On the other hand, if too much capital is flowing in the country, it will increase what? It will increase the inflation, right? And the value of the nation's currency as well, making its export uncompetitive. Countries like, if we talk about our country, if we talk about India, countries like India employ capital controls to ensure that their citizens' money is invested at home rather than it is being invested abroad. Yeah. One more thing that I wanted to discuss with you people is, People get juggled between, all these things are fine, but what is the difference between, capital market and bank loans? See, when we talk about regular banking is not casually classed as capital market transaction, even when loans are extended for a period longer than a year. First thing, what happens is the regular bank loans are not securitized. That is, they do not take the form of a resaleable security like a share or a bond that can be traded on the markets. Second, lending from banks is more heavily regulated than capital market lending. Third thing, bank depositors tend to be more risk averse than the capital market investors. These three differences all act to limit your institutional lending as a source of finance. Right. Now, the two additional differences, this time favoring lending by banks, are that banks are more accessible for small and medium-sized companies that have the ability to create money as they live. In the 20th century, when we talk about, most company finances, apart from the share issues, were raised via bank loans only. But since 1980, there has been an ongoing trend of disintermediation, where large and credit-worthy companies are found. They effectively have to pay out less interest if they borrow directly from the capital market rather from the banks. The tendency for companies to borrow from capital markets instead of the banks have been especially strong when we talk about countries like the US. And according to the Financial Times, the capital markets overtook bank lending as the leading source of long-term finance in the 2000s, which reflects the risk aversion and the bank regulations in the wake of 2008 financial crisis. When we compare, United States companies to the companies in the European Union, companies in the European Union have a greater reliance on your bank lending for funding. Efforts to enable companies to raise more funding through capital market are being coordinated by a European Union's Capital Markets Union initiatives as well. So what happens is when a government is, trying to raise a long-term finance, let us take a name. So it will often sell the bonds to the capital market. In the 20th or your 21st centuries, many governments would use your investment banks to organize the sale of the bonds. The leading bank would underwrite the bonds and would often head up to a syndicate of, brokers, some of whom might be based in other investment banks. The syndicate would then sell to various investors. So for developing countries, a multilateral development bank would sometimes provide an additional layer of underwriting, resulting in risk being shared between the investment banks, the multilateral organizations, and the end investors. But since 1997, it has been increasingly common for the governments for the larger nations to bypass the investment banks for making their bonds directly available for purchases online. Many governments now sell most of their bonds by computerized auctions, and typically large volumes are being put up for sale in one day. A government may only hold a small number of auctions each year, and some governments will also sell a continuous stream of bonds throughout, other channels. The biggest single seller of the debt, if we talk about US government, is your US government. So US government is nothing but the biggest single seller of the debt. And there are several, transactions for such sales every second, which corresponds to the continuous updating of the US real-time debt law, right? So that was a quick introduction, guys, to what is capital market? We understood that. What are suppliers and what are the primary market, what are secondary market, what are stock market, bond market, what is the difference between capital market and bank loans. We took an overview of all these things. So this is where we are going to wrap up this session for today. From tomorrow on, we will be trying to use our, data science terminologies and techniques in the coming sessions from tomorrow. So again, thank you so much, guys. You have been a wonderful audience, and it was a pleasure taking this session for you people. See you guys again tomorrow from 4 p.m. Thank you so much, guys. Be safe. Have a wonderful day. Thank you.